So yeah, Division 296 tax. So this was something that came up last year and was quite controversial for a number of reasons. So what is it? As I say, initially it was part of the 2024 federal government's budget and really aimed at ensuring fairness in the superannuation system. Now, what it applies to is an additional 15% tax on earnings in superannuation for people that have balances above $3 million and 25% additional tax on balances above $10 million. So we're talking quite large balances there. Now, probably worth mentioning at this point that a lot of the attendees tonight will have self-managed super funds. So those balances are individual member balances. So if you've got more than one member in your self-managed super fund and your total self-managed super fund balance is above $3 million, but your individual balances are less than 3 million, then it wouldn't apply to yourself, or not for now anyway. Now, in fact, just last week, this actually went back through Parliament. They made some changes to it, which we'll cover off on, but now it's through Parliament. So this is now coming into effect from the 1st of July, 2026 for the 2027 financial year. And as I say, the real purpose of it from the government's point of view is to target those very high super balances. So as Paul mentioned before, superannuation, it's not there to create tax benefits for super rich or anything like that. So the government feels this is a way of balancing it out a little bit and making sure that some people aren't disproportionately benefited from the superannuation system. I guess probably the important thing here is what's really changed from last year. So one of the most controversial parts about it when it was first introduced was that they were going to apply the tax to unrealised capital gains. So I think we're all familiar with the idea that you sell an asset and you might pay capital gains tax on it. Originally, the idea was that any gains in your super fund, whether they'd been unrealised or not, once you're above those amounts, would actually be taxed. So that creates a lot of problems, but also I think like fundamentally it's a big change in the way that we consider taxing people in Australia. And a lot of people thought that they do it to superannuation, they're going to start doing it to other areas as well. So it was very controversial. Didn't look like the government was going to get it through both houses of parliament. And so sure enough, they've backed down on that and it no longer applies to those unrealised capital gains. The other controversial part about it was that although the government said, of course, those $3 million limits and $10 million limits will increase over time, they hadn't specified how or when that would actually happen. A lot of people thought that, particularly for young people, they might be a long way off having $3 million in super, but over the next 30, 40 years of their working life, and Paul talked about the effects of inflation, it's actually quite conceivable that those people would end up with well above $3 million, and this perhaps was a way of getting ordinary Australians to pay more tax from their superannuation. So again, the government's perhaps realised that to get it through Parliament, they had to be more specific here. So they are now indexing that to the basically inflation, the consumer price index. And so essentially at different stages, that $3 million cap will jump by 150,000 and that $10 million cap by 500,000 respectively. Now, they've also introduced some measures to make sure that people can't avoid the tax. So trying to make sure that people don't just withdraw lots of money from super just before they get to potentially that $3 million limit. But I think that's pretty normal with these things. The intent of it is just to make sure that people with super large super balances aren't getting too much of a tax benefit. I think having integrity measures probably makes a bit of sense. So I think from something, when we started talking about this about a year ago, it was definitely a big issue and was potentially going to affect a lot of our clients. I think now with the way they've restructured it, it probably isn't going to affect too many, but of course, if it is something you're concerned about, definitely contact us and we're happy to discuss it. One other thing to consider with it is that whilst, as I said, it does only affect individual member balances, there can be situations where if one member of the super fund passes away and those assets move to the other member, then potentially that could then suddenly put them in a position where they are over $3 million. So something to consider there as well.